Okay, good afternoon, everybody. Welcome to the Business BoardCast. I think this is actually our 20th Business BoardCast. I can't believe it's gone by so quickly. I am joined today by the lovely Felix, Guy Smith. So any of the fans for Guy Smith, I'm really sorry, but he's on the bench having a well-deserved rest today. But I'm being well looked after by having Pete with me. So hi, Pete. How are you?
I'm good. Thank you for having me on. Yeah, great. Can't believe this is the 20th one. It seems like only yesterday you started this. Where does the time go?
Yeah, it's really fantastic. So we're both obviously recording from home today, and it looks like you're in a very serene area. Have you got? Is it a Buddha behind
yes,
you?
that's my yin and yang being perfectly balanced behind me. So yeah, you're in my study, and behind me is my sort of tranquil picture. So when I get stressed, I just look, and then it brings me back down to earth again. Yes.
Lovely. Looks really, really good.
It makes a change from, and other things. I think it always draws comments from clients as to what is that picture behind you. So it's a talking piece.
Yeah, it's good.
Yes.
Very good. I've just got my still got my Zoom cartoon behind me on my piano.
Have you?
We've got this really good cartoonist that does great cartoons for our company. So anyway, so today we are going to be talking about unlocking finance on your balance sheet. And this is really relevant for any business owner, whether it's they're short of cash or they're looking for growing and therefore they need additional investment. So I've asked Pete along because he's been providing this type of service for clients for businesses well over 30 years. He doesn't look it, but he has been been working since he was a little boy. He must have been. So let's go straight in, Pete. So why should a business be concerned that the money is locked up in their balance sheet?
Thank you. I think for a lot of businesses, it's all about the opportunities that the availability of cash gives them. So if you're in a situation now where you're coming out of the lockdown, it's been 18 months of really hard slog, and I take my hat off to the business owners who've survived that, who are now trying to fulfill their potential, and they're now coming back into what was reality maybe pre-COVID, where you're having to acquire stock, you're having to service your client base, and then you're having to wait for payment. So that whole process leads to cash being tied up in the balance sheet, be it in stock, or be it in debtors, or be it in work in progress in between the two things. So if you take a typical business that's bringing in goods from China, selling it into a multiple retailer, from the day of the purchase order to the date of payment could be up to 180 days. That's a long time.
Wow, 180 days. That's
in most cases. It could be a lot. And the situation is how do they acquire the stock? How do they manage the process in the middle, then manage to trade debtors, and then have the cash to be able to trade through and pay their current liabilities? That's really what I'm on about in terms of getting the cash unlocked from your balance sheet to be able to do that. And I'm seeing lots and lots of businesses, particularly trading businesses, who are coming to people like me. I'm not the only person that does this, to release working capital to enable them to be able to trade through. So so to answer your question, it's the old mantra, cash is king. If cash is tied up, there's no ability for you to take on any opportunities that currently present yourself. And also there's a high risk now that any minor upturn could lead to one of your clients, one of my clients, without adequate working capital, succumbing to overtrading. Just imagine how horrible that would be. They've survived COVID. They've been able to pay back their deferred loans, HMRC deferments, and they're then caught out by the fact there's too much business and they can't finance it. They've overtraded, and that's criminal. That's why it's important.
Absolutely awful. So let's go into a bit detail on that balance sheet. So you
Okay.
mentioned some of the things that it can be locked up in.
Yes.
So can we just go through those particular ones sort of in detail? So the sorts of the types of items on the balance sheet that's be locking up cash. Can we go through them so that the businesses can think about, oh, have I got them or not? So what are those typical items on the balance sheet that are causing the lockups?
I think probably the easiest way to perhaps answer that is to talk about my latest deal I did, where we've gone entirely through all those aspects of the balance sheet. So the listener can say, yeah, that's me, or I know someone who's in that position. So we've deployed £750,000 to a business, which extensively doesn't seem like a lot of money, but it's a lot of money to them. And they are in the sort of, I guess you would say, the beauty market. So they manufacture ladies' cosmetics, which are manufactured in Europe. They are then sold into multiple retailers. Multiple retailers then take end of month following terms to pay them. So they came to us with a very good order book from some very good names who have, during COVID, have been recession proof because they're multiple retailers. And they were the only businesses that were trading consistently throughout COVID. So the problem the prospect had was that the suppliers wanted money up front. And to be honest, you couldn't blame them. They've had a really torrid time and they've got no idea whether or not this supplier is going to pay them. So they needed cash. So what we did is to step in the shoes of the prospect and paid the supplier. That allowed our prospect to bring the goods in, place them into stock, supply the retailer, and the retailer was paying at end of month following terms, which in reality is anywhere between 45 and 60 days. So as soon as the invoice was raised, we're able to release funds against the invoice, which then goes back and we pay the trade line. So in that way, the entire funding line, which equates to just under 150 days, was funded from the start to the beginning, which gave the client the liquidity to take the opportunity that presented itself to them that they would not have been able to fund. Now, putting that in perspective, they could have gone to a bank and it would have taken perhaps maybe 6 to 8 weeks for the bank to make a decision on that particular deal. And it's coincidentally that bank said no. They'd gone to another bank. The bank wasn't too happy to lend because they had a C-bills which was provided by the existing bank, and therefore you can't move bank account if you've got the C-bills arranged by another bank. Banks won't take you on that basis. So luckily, I deal with some really, really excellent intermediaries who've known me for 30 odd years, who said this is something that Pete can probably look at. And what I like about the people I deal with is the honesty and transparency at which they introduce business to me. Because they know what I like, they know how I work, and they gave me this synopsis, warts and all. And they know that the company I work for, very much about transparency and helping clients. And we're able to deliver that solution. So from that example, you can see us unlocking cash throughout the process, from order to stock to debtors to payment in that one file swoop.
Absolutely. And we've had a really good comment that's really relevant from Nigel, who introduced us originally.
Hi, Nigel.
And so he's making a really good point, and we need to go into a bit more detail on this. So even with strong companies, it's good to have credit lines in place, as we are all still faced with supply issues, because we are, aren't we? There isn't such a thing almost as just in time anymore. People are waiting. I mean, I've got a client that supplies flood doors. And that's great to get the orders in, but their manufacturer keeps delaying, and that just makes the process longer and longer. Or they're waiting for aluminium, deliveries or whatever, and that price keeps going up. So what is your advice to the business owner out there of when to get the credit lines in place?
Well, it goes back to what I said earlier. It's about the fact that opportunities are beginning to present themselves. And I always believe that if you plan for an event, it's much better than to rush around expecting a lender to dance to your tune, because you suddenly you often see people, they've got an opportunity, and suddenly they can't fulfill it because they expect the lender to get it done yesterday. Whereas the businesses that Nigel mentioned, who are well organized and they are forward thinking and they actually run on a cash flow basis, and these are the people that actually look at their cash flow, they can actually see what's going on. So most of our clients fall into that category where they will say to me, well, in October 2022, this is what we're going to need. Therefore, we'll come to you early part of the year to plan, have the facility agreed at this level, and it needs to be ratcheted to that level. So they are planning their cash needs ahead. Secondly, a lot of businesses can be a little bit complacent in that they look at their balance sheet and they think, well, that's fine. They've got cash on bank, they've got debtors, it all looks rosy. But what they don't realize is that there's a lot of uncertainty in the marketplace. For example, I can't believe how many businesses don't have trade insurance covering their trade receivables. And when you suddenly see, because don't forget, the insurance companies won't insure companies which we all know to be bad risk. They just won't do that. They'll insure companies which could become a bad risk at some point. And it's at that some point when you see businesses caught out, particularly with some of the well-known names that have gone, and suddenly what was a strong balance sheet is now being wiped out.
Yes, indeed. Nigel was saying this morning about, I had an early morning meeting as always, Nigel, on a Friday morning, and he was mentioning about a quite reasonably sized building business that went out of business a couple of weeks ago, and that's causing ripples all down the supply chain. So you've got so having that insurance in place, it's just another thing to be able to help you sleep. I've had another question come in for you, Pete. So this is for Guy. So for Guy Smith fans, he is still here contributing. Hi, Guy. So he's asking, so with HMRC being more aggressive chasing debt, so they are picking up a little bit more aggressively. They're still not back to pre-COVID levels of aggression, but they are definitely, they're being more active now. Could this be an option for businesses unable to reach a time to pay arrangement for HMRC? Although I would say, can they really not do it? Speak to Guy and he probably will get them one, first of all. But if they haven't been sensible enough to get Guy in their corner to sort that out for them, what would you say, Pete?
Okay, I think Guy raises a very, very good point, because I believe I read somewhere that 600,000 businesses have failed to honour their time to pay arrangements with HMRC. I do know that HMRC have taken on additional staff, and I don't think they're taking those staff on because they want to reduce unemployment, do they? They want to make sure they get their funds in. Absolutely. So what we're finding is that repayment of your HMRC liability built up over COVID is just an additional battle that SMEs have got to fight, in addition to paying suppliers, maintaining staff. I mean, you see there's a labour shortage for many businesses out there. So you're getting wage push inflation, so they have to compete in that market. Then on top of that, they've got to repay the HMRC liability. So if they've got cash tied up in their balance sheet, it seems sensible to me to pull the debtor days forward by allowing funding to be released against the current assets, which allows them to meet their current liabilities, which could include HMRC payments. And as opposed to sitting on it, I mean that HMRC is now a preferential creditor. Therefore, it's going to rank above your secured creditors, who may take a dim view about whether they support you or not, because you're sitting in a commercial bank and you've got someone coming to you and they've got a level of HMRC liability that you're thinking, well, if I provide some funding in here and this business falls, HMRC jumps over my debenture, they get paid. Therefore, the only way I can secure myself is by taking a large personal guarantee from the directors. And then that all runs into problems with the director in that most people own their houses cohabitively with someone else. So you're going to have to get consent to mortgage. You're going to have to get the person taking independent legal advice because their home is now at risk. And it's easier for the banks to say, we don't really want that hassle, so we're going to say no. So that leaves the alternative funding market, people like me, to alleviate that creditor pressure at that time. And I think what people need to understand is that just because you've gone to an alternative funder doesn't mean you're stuck there forever. As a business begins to trade, and if your business projections are accurate, most people give these projections saying, I will make profit in the next 18 months or whatever timescale that will be. Surely at that point, when customers pay and profits are retained, that retained profit turns into cash. If you rely on people like me, reduced over a period of time. But it's what do you do now to keep your business going? So I agree with Guy. This will help.
Indeed. So we have mentioned different types of funding. I thought it would be a good idea to go through some of the different types and perhaps the pros and cons. So I wonder if you could lead me off with a few of the most common types of funding that businesses normally will take out.
Again, starting from the very, very basic. I mean, most people, when they start a business, they have a business idea. They don't really know how to monetize that or how to fund it. So the first thing they do is go to their bank. They will take their idea into the bank because the bank has been their go-to source for many years. And particularly at that point, most of these people don't realize they need an accountant. They don't understand this at this stage. So they go to the bank will then provide an overdraft facility. So the overdraft facility is fit for purpose at that time, which allows them to get their business started. The problem with an overdraft is that it's not easily scalable because the bank will be taking a retrospective look at the available assets to cover the overdraft. So the overdraft limit's been agreed at, say, 50,000. The business needs a trading facility of 60. They've got to go back, get it rearranged, get it negotiated, and they have to pay an arrangement fee on the increase. The second thing that people are used to are loans, because in personal life, they may have taken out a car loan when they're young. They may have taken out a mortgage, which technically is a regulated loan, and therefore they go to the bank asking for the same. So the loan's granted, you get a bullet injection of cash at that point. Problem with the loan, once it's gone, it's gone. So you then have to renegotiate another one, and you don't have any idea as to what your available security will be at that point. The third source that people will often go to is an investor, and may decide that they're going to have an equity giveaway in exchange for an injection of capital. Now, we all know that equity is fantastic, but it's very expensive. It's a very expensive way of funding your working capital because you're giving away a share of your business, and the equity investor is looking for a return. Typically, it's going to be on their ticket when they want to exit, and you have to adhere to that. Then you've got alternative funders like me who provide invoice finance, which is linked to your trade receivables. So as your business begins to scale, the availability of working capital grow in line with your sale. The only drawback, because it's based around your debtors, as your debtors begin to decrease, the amount of cash generated from a working capital facility, such as what I sell, reduces also. So businesses which have any degree of seasonality to them, what we tend to do there is look at where the peak selling periods are, and we know that invoice discounting is going to work. Then we look at the low selling period, and that's where we work with our partners, normally the banks, to say, right, during this low period, you need to have an overdraft facility in there or some form of working capital in that place. And we pick up maybe 2/3 of the burden. You pick up 1/3. So those are the typical options. Obviously, bigger companies have more options than a small SME. But in terms of where we operate, which is in the SME space, from 1 to 250 million, their options are more limited. And they may not think that they are, but they are. And they don't want to be in a situation where their perceptions of a type of finance restricts their ability to grow their business and to take advantage of the opportunities that are there. So those are the common ones. I could go into lots of others, but it will just be distracting.
So if somebody's thinking, oh, well, actually, perhaps I want to investigate potentially invoice factoring or invoice financing, invoice discounting, what should be their first step? What should they do before, what are the practical steps that they should take, before they approach someone like yourself?
Okay. I think the most important thing is be prepared and be professional, because you're asking someone to invest in your business. So you cannot go to an investor of funds not being organized. So you've got to think about an invoice finance company. What does an invoice finance company do? We buy debt, we buy trade receivables. So have your aged debtor report ready. Make sure that aged debtor report is clean. So if you've got sitting over 90 days, it's like someone having a massive nose. It sticks out. Therefore, the invoice finance company will come straight in on that. Have answers to why debts are that old. If your ledger is concentrated, that means that you have all your eggs in one basket. Why is that the case? What is the impact if that debtor decide to no longer wish to trade with you? There's no point saying to the invoice finance company, you've got a fantastic relationship with Sainsbury's. No, you haven't. You've got a fantastic relationship with the buyer who buys your product. When that buyer goes, you'll bring in his suppliers. That's exactly what I would do if I was a buyer, because you work with people who've never let you down. Your trade creditor position, so have your trade creditor listing ready. Again, like your debtors, if your trade payables show a lot of content in the 90-day column, why aren't you paying your trade creditors? Is there potential CCJs building here? Are you likely to be sued? That's how the invoice finance company will be thinking. Secondly, have a clear understanding of your audit trail. How do you make your pounds? Does it come from a purchase order? Is that purchase order by email? Written purchase orders? How do you make your pounds? How do you make your delivery? How do you prove your delivery has been made? Is your invoice fit for purpose? Does it actually state what the client has purchased and what they expect to pay? And that then mitigates disputes such as credit notes. Because if I say to you, Nicky, it's going to cost you £450, you're going to invoice for £750, you're going to query that. And it's amazing that these little mistakes companies present to an invoice finance company and wonder why it takes so long to transact a deal. Your financials, be on top of your financials. So audited accounts, management accounts if produced. If you're making losses, be brave, be upfront. Why did you make a loss? What steps are you taking to mitigate that? Because although the invoice finance company is buying the debt and the exit is through the debt, there's a duty of care to the business. So the business has got to pay fees on the service we provide. So we want to make sure the business can afford it, and we're not adding to the company's burden. So if the company's made a loss, it doesn't preclude them from our service, but what it does do, it allows us to say via projections, will this business be profitable? Because this is what the underwriter wants to know. Will this business be profitable within a specific period of time? Because if I can't prove that to my underwriter, as much as I'd want to grab him by the throat, he will not sanction the deal, because I cannot tell him that it's going to be for the benefit of the client. So clients have got to be organized. And people often say, I didn't get any finance from the bank, and they point the fingers at the banks or the invoice finance company. But invariably, there's always 4 fingers pointing back at them as to why they didn't get it. Because we're simple creatures, Nicky. We're very simple. Give us the information, prove to us you understand it, and you got your deal. If you don't understand it, I'm not going to understand it.
No, indeed. So we've got a few more questions come in, a few comments. Okay. So let's share those in our last 5 minutes. Okay. So Nigel, another commentary. Good advice, Pete. Tidy, transparent management accounts equate to a tidy company. Absolutely, I completely agree. All our most successful clients, they have regular management accounts. That's definitely, you can't run your business from yearly accounts. You need nice, monthly, if not weekly accounts ready to go. And then we've got really good question here for Megan. So Megan says, why should I consider invoice finance in comparison to an overdraft? Now, I know you mentioned that it was a bit about the timings and different things, but do you have a succinct answer for Megan?
Okay. I think an overdraft is a very simple and blunt tool. So the banks, in fairness to them, they get requested by a client for an overdraft. You get a bullet payment of cash. You get a facility which you can trade within. But that facility is based on a number of an analysis on the bank based on what happened retrospectively within your business. So your account's about 18 months old by the time you've done that. The overdraft does not take into considerations things which come left of field, like a large order or debtors slowing down payments. Now, the overdraft, when an overdraft is provided from the bank's perspective, it should basically go black, red, black, red, black, red. Now, concern for a bank, any bank, I can't blame the banks for this, if an overdraft becomes hardcore, so the balance never reduces. So it becomes a loan, despite the fact there's no loan agreement agreed between the bank and the customer.
Yeah.
The client is likely to get into unauthorized overdraft borrowing rates, which I know people penalize the banks for, but they've got to look at the bank. The bank is not a division of Oxfam charity. It's not a charity. And that sort of level of capital costs the bank a lot of money. Hence why they have to charge a 29% APR, because it's very expensive capital and they get penalized by the regulators if they don't. So for those reasons, a facility linked to your turnover is better, because as your business begins to grow and your working capital requirement grows, it grows in line with your cash need. And also in terms of providing such a level of finance, the risk of providing it is less than the risk of providing an overdraft, because with a bank overdraft, the repayment vehicle is you, the borrower. That's one person. With an invoice finance division, it's the entire customer base. So the risk is spread amongst the sales ledger. So if I'm lending you £1 million against a sales ledger, and you've got a sales ledger with an active customer base of 1 million debtors, that's my repayment vehicle. If I lend you £1 million individually, I've got your house, or I've got whatever other tangible security you give me. You've now given me a court battle to go and get my money. And it's then whether I want that hassle. So it may be easier for me to say, no, your business doesn't have the ability to afford that level of funding. With an invoice finance company, providing the debts are contractually complete, that means you've done what you've said you're going to do and you can prove it. It means that the debtor has to pay, and the debtor has to pay regardless of whether you, the suppliers, are there or not. And that's why it's better. So overdrafts, simple, clean if you're a ma and pa business. If you're a business that wants to be a little bit more than a ma and pa business, then you are looking at some form of facility that is growing with you and is on a non-amortizing basis. That's my answer.
Excellent. Really, really helpful. Thank you, Pete. So I think we've had loads of information there. So hopefully that's given lots of business out there some ideas. how they should be looking forward planning. I think that's been the key message, looking ahead, making sure their books are tidy. So when they go to their bank or a invoice factoring company, that there shouldn't be any barriers to them getting that funding. So Pete, if somebody would like to have a further, more detailed chat with you, and I know that you're already out and about doing coffees and lunches and everything already.
Yes.
When you're not on your Christmas cruise, obviously. So
that's not until the 26th. Yes.
So what's the best way to get hold of you?
Okay.
Pete?
Well, the best way to get a hold of me, I've got a fairly active LinkedIn profile. I think a lot of people probably tuning in already LinkedIn with me. I don't think there's very few people in this sector that I don't know. You can reach me at peter@getmymuse.com. So that's peter@getmymuse.com. My telephone number is on my LinkedIn page. You can find me via Nicky, because I'm linked in with her. So those are the best means. As Nicky says, yes, I'm busy.
Absolutely, yeah. I'm linked. Yeah,
everyone wants to see me at the moment, but I'll always.
Yeah, it should be easy to find on LinkedIn. If not, then always do ask me, and I will point you in the right direction. So thank you very much, Pete. It's been a delight, and lots of really great information for businesses out there. As always, if you've missed part of this, this will be recorded and will be shown on YouTube, on our YouTube channel, Gorringe Accountants. Do like and subscribe to our YouTube channel. And next week we have the lovely Nick Babington here with us. He's going to be talking about employee health programs, employee assistance programs, in fact, EAPs. So which are really, really good, that you can do lots of proactivity helping in your business for positive mental health for your teams. The following week, I have the lovely young Cal coming from a Yes Tax, who's going to be delving into property capital allowances. But Guy fans, don't worry, Guy Smith is back the following week, and he's going to be discussing tax consequences on Christmas entertainment. So thank you very much again, Pete. Lovely to see you, and I'll hopefully catch up with you soon. Thank you, everybody, for listening, and cheerio.
Bye-bye. Good weekend, everyone.